Warren Buffett is one of those people who doesn't need foreplay, as he's the patron saint of investing for virtually anyone who dabbles in stock picking. He is respected by many because he did something truly extraordinary. He became one of the richest men in the world not through innovative technology or billions of inheritances, but by half a century of consistent stock market victories. Learn more about Warren Buffett's role in becoming an investment billionaire. Warren Buffett's vast fortune is tied to Berkshire Hathaway, astronomically the largest conglomerate in the lumber industry. But Buffett's beginnings are much humbler. Born in Omaha in 1930, the stock market crashed 6 months before him, and Nebraska was hit particularly hard. The state's economy relies on agriculture, and many communities have been devastated by the collapse in crop prices. Buffett himself was lucky enough to be born into the family of local stockbroker Howard Buffett. Warren's father was a shrewd businessman, so he was able to support his family despite the collapse when the economy began to recover. He ran for Congress as a member and won the election despite the immense popularity of Roosevelt and the Democratic Party at the time. Amid his political career, Howard moved with the Buffets to Washington, D.C., where Warren naturally felt very alone. He spent his days doing math both at home and school, and his reading invested in his father's studies. It was during those early years that Warren was instilled with a desire to get rich. He told his school friends that if he hadn't become a millionaire by the time he was 30, he would have jumped off the tallest building he could find. To that end, Warren started playing the stock market before graduating from high school, buying a few shares here and there to visually see how things were going. But Warren's ambitions weren't limited to the stock market. One of the books he read inspired him to do just about any business he could think of. He bought his 6-pack of Coca-Cola and sold it to his classmates at a premium. His Coca-Cola work began in 1944 when he started distributing the Washington Post in his neighborhood. That year, 14-year-old Warren Buffett filed his first ever tax return, along with his $45 deduction and visual inspection of the bike. He used his money to distribute newspapers, bought a pinball machine, and installed it in a neighborhood store. I was forced. Warren sold his pinball business in Washington, D.C. for just over $1,000, and upon returning to Nebraska, he used the money to buy a 40-acre farm, which he rented out. Warren took advantage of his farm lease to attend the University of Nebraska, where he earned a bachelor's degree in business administration. At age 19, he applied to Harvard's business school but was rejected, so he decided on his next best option, Columbia Business School. There he met a builder who changed his life forever. This man, Benjamin Graham, will go down in history as one of his value investors. The two met in his 1949. The same year Graham published his masterpiece, The Perspicuous Investor. In this book, Graham creates a step-by-step guide to successful investing in his always eliminating fictional theories. In short, his approach was to find decent companies at bargain prices, and basically, he was to find $1 stocks trading at 50 cents. Buffett fell in love with the method and soon became one of Graham's favorite students. Just a few years after graduating, Warren went to work at Graham's investment firm. There, Warren mastered the art of security analytics and learned how to visually identify a company's true value simply by looking at the numbers. But just 2 years after his retirement, he decided to close his business and leave the year alone. At the time, Buffett had $175,000 in savings, which he used to enter into a partnership that allowed him to use Graham's method. He began looking for companies that were essentially cigarette butts. He started looking for companies that didn't perform well but were still undervalued by the market, companies that were still promising for their next hit. An example is shown below. In 1958, Buffett explained that Sanborn, his maps company, had a virtual monopoly on producing detailed maps used in the compensation business. The company has been around for about 100 years and has had a rough past decade, but Buffett explains something interesting in his book. Over the past 20 years, he has invested his profits in over 40 different stocks. Buffett calculated that the company's shares were trading at about $45 a share for him, while his investment portfolio alone was worth $65. Not surprisingly, Buffett began buying shares in Sanborn until he owned a majority of the voting rights, then sold his investment portfolio. In effect, he bought his $65 for his $45. And over 2 years with virtually no risk, he earned a 45% return. Warren's early investments follow the same philosophy and unsurprisingly outperformed his stock market fourfold. So, in January 1962, 32-year-old Warren officially became a millionaire just 2 years after promising to jump off a building. That same year, Warren came across a cigarette butt that caught his eye. A struggling textile company called Berkshire Hathaway. The textile industry in early England was in decline for decades, and Berkshire closed 9 of his 11 textile mills. The stock itself was trading at around $7, but the assets were worth at least $11. But here's the problem. The company's then CEO used all the money the company made to buy back its stock. So whenever Berkshire sold another factory, it offered to buy out its share of the business, essentially liquidating one factory at a time. Warren bought a large number of shares he bought for $7 and eagerly waited for the CEO's office to buy them back. Years later, the two agreed on a price of $11.50 per share for him, but when the day came, the price offered was only $11.375. The CEO tried to swindle Buffett out of his 13 cents, but instead, Warren bought the entire company and fired Buffett. But now Warren had a shrinking business he couldn't live without. Rather than let Berkshire go to waste, Warren began investing in the company. But this unfortunate experience changed his philosophy dramatically. Instead of looking for cigarette butts and mediocre companies with low prices, he started looking for great companies with fair prices. Drawing on this initial philosophy, his first purchase was his American Express. The company is still owned by him today. Buffett has used his analytical skills to find the best stocks across the market, and that's only part of the reason he's been so successful. Entered the business. It may sound weird, but after all, sickness coverage is pretty old and you wouldn't expect madness to double every year. But Warren has visually found his way to ultimate wealth in this very business. So he began his 1967 acquisition of immunity companies, beginning with National Indemnity. And in 1996, he culminated with Geico. That's why Buffett fell in love with compensation companies. They are essentially like banks. Thousands of people traditionally pay their coverage insurance premiums, effectively giving an insured society a huge cash balance, but something unfortunate happens. Like when their house burns down or their car breaks down. In other words, Buffett bought a company for $1 billion in cash, which was technically considered a liability. So it didn't factor in the purchase price. Did not. Suddenly he had access to a huge amount of capital and invested in A-class companies wisely and conscientiously. By 1983, Berkshire's portfolio exceeded $1 billion, making Buffett himself worth $1 billion just 3 years later.